G'day ladies and gentlemen, my name's Craig Cobb from the Grow Me Co. I've been trading for over 20 years, full-time for 15, and in this series I'm going to be taking you through some of the most important elements to being a consistent trader moving forward. The good news is it's relatively simple and it's all within this program. So hit subscribe, turn on your notifications and open a BloFin account and the link below. So now that we've gone through the first stage, and if you haven't seen the first stage, go and have a look when we talk about trend. We're now going to overlay moving averages, and this comes around the understanding and mastering of price action, the one true item on a chart that is real price measured by time. We're going to bring in the moving averages to help us to smooth that out and to see price and how it operates within certain zones and trends. So we're overlaying moving averages with trend and price action. It's not a complicated thing that we're doing here, but we're doing it in a layered approach so that we get the desired outcome. Now, MA stands for moving averages. And what it does here and what we're going to use it for is smoothing out price action as price does move in a rhythm. Think of it like a wave that breaks. The ocean will move and move and move, and then when the right time comes, it hits that sandbank or that reef or those rocks and it breaks a certain way. Well, it breaks that certain way time and time again when the conditions are correct. So we use those moving averages to spot where the reef is and to know when the direction of swell is correct for it to break the way that we want it to break. Learning to read that rhythm and understanding how price action with the moving averages how it operates and where the high probability outcomes come from is absolutely crucial. For me, and for what you're going to learn, moving averages provide me with a buy zone and a sell zone. A buy zone for going long naturally and a sell zone for when it's time to be shorting the market. Now, I'm going to show this to you in a live market scenario in just a moment, but I'm going to first of all show you the two moving averages that I actually use. I use the 10 period and 20 period moving average. Now I use the exponential moving average as opposed to the simple, and it doesn't really make that much of a difference, to be honest with you. It's a zone that I use it for, and that zone, as you'll see in just a moment, to capture an area where I believe opportunity exists. The 10 period moving average is just literally the last 10 candles on that chart. The good thing about it is it doesn't matter the time frame. 10 candles is 10 candles. And what you'll notice throughout this program that I'm showing to you on YouTube is that simplicity is key. Keep it simple. It makes it easier to get it right and harder to get it wrong. So the 10 period moving average is literally the last 10 candles on the chart, and it's smoothed out in what I've represented there as a black line against my white background charts. The 20 period moving average is, you guessed it, the last 20 candles smoothed out on the chart as well. And when combined with something like an uptrend or a downtrend, this moving average zone that I speak of can be very, very lucrative for the right type of trader. Now, a couple of things that I want to point out is naturally what not to do. So don't use moving averages as support and resistance. And I know, lots of people out there that suggest that you should. Well, you can do it if you want to, or you can take it from someone who's been doing this for 20 years. They're not support and resistance. They're a moving average of the price. As price moves, the averages will move with it. It's all in the name. It's a moving average. A moving average of what, you might ask? It's a moving average of price action. Remember, price action is the one truth. It's price measured by time. So we're going to be using the moving averages not for support and resistance. What if the moving averages get touched by price? Or what if the two moving averages cross over in the case of a dead cross or a golden cross? Again, zero relevance at all. Once again, I will, make it clear that the moving averages, the 10 period will cross up through the 20 period moving average when prices sustain some upside momentum. You see, it is the trends that will make the moving averages cross. And just because a moving average crosses to the upside, for example, in a golden cross type scenario, it doesn't mean the price is going to move higher. What it does mean is that the price has already moved higher. So we're not going to use it for prices touching or price crossing, moving averages crossing. It's absolute rubbish. It's completely nonsensical, and it's not how I trade, and therefore I'm not going to teach you how to do it. We use moving averages as a zone to indicate to us places for which we may look for a trend to go, a trade to go long or a trade to go short. They are there as a guide, and they are a zone as opposed to a science because they are in and around a certain point. As you can see, the buy cradle zone is in and around the 10 and 20 moving average, okay? In an uptrend, okay? Higher low, higher high, moving averages in the correct order, price pulls back into that zone, that is the buy zone. In a downtrend, moving averages are the 10 is below the 20, there's fanned out, we've got a downtrend of lower highs and lower lows. When price pulls back into that zone, it's our sell zone. And this has just highlighted to you what I've just said in the form of a chart. When the price pulls back into this zone, I am looking for opportunities in an uptrend for a long, in a downtrend for a short. Now, how do we actually use this in the real market? Well, I'm about to show you right now. Coming across, and I will use Bitcoin again for this long example, because what I've got right now is a couple of things. I have a clear series of higher lows and higher highs. Here is my last higher low, and here is my most recent higher high. Now, price has pulled back into these moving averages, and this on this chart, because my charts are black. Why are they black and not white? Well, white shows up better on slides, but when I'm spending a lot of time looking at the screens, white burns my eyes, so I go for a black background. For me, the 20 period moving average is the red, or this maroon color, and the white period is the white moving averages is the 10, and you can see that shown up here. Now, as you can see, each time in this market move in the last, year and a half, we've got each time we've pulled back into these moving averages, back into this cradle zone long, we've moved out of there higher. We came back in again over here, and we moved higher. This time we're back into this moving average zone, and this for me is an area for which I start to become alerted for trading opportunities. Now, it's one ingredient, one element within a trading strategy. It is not the be all end all. But if you are someone who's just looking for dollar cost averaging, well, it's not a bad idea that when you've got a good trend like this and you've got good momentum and higher lows and higher highs, that this would be an area to consider buying more Bitcoin as opposed to when it's in a ripping run like this. I always prefer to be buying pullbacks and selling pullbacks if I'm going short. So using these moving averages in this light, higher low to a higher high, price pulls back into this moving average zone. I am now on alert for trading opportunities, and you can see history presents that it does work well. And you can literally go to any chart and any time frame and test this. As a matter of fact, let's go ahead and do that right now. Let's go to, I don't know, we'll see what we've got here. On the Ethereum chart, we'll go down through some of the lower time frames. Nothing there. I've got to find something that is trending. Here we go. Perfect. Cardano. We're looking at a 4-hour chart here on Cardano. And again, there is a lower high to lower low, lower high to lower low. Now, all that matters is over here, right? But what you can see is very evident when price pulls back into this region in and around the 10 and 20. Okay, so this is in and around that highlighted zone. We get a move to the downside. We pull back into this zone in a downtrend. We then move away. So naturally, if I'm a trader, which I am, and I'm looking to make money, well, the first thing I'll look at is we have a downtrend. Okay, good. So I'll be looking for shorts. Second thing I'm looking for is, okay, I'm going to wait until price pulls back into this cradle zone, this sell zone. And if I get something in there, you build a trading strategy around that zone, sure, I'm happy to short. Now, I'm not suggesting that each of these were shorting opportunities, but what I am showing is some of the layered approach to creating a confluence of events, which ends up being a trading strategy. And once you have a trading strategy, you will start to piece things together and know exactly what it is that you're looking for. To keep this section very, very simple, we use moving averages in conjunction with trends to be able to point out to us areas of which we start to become interested within that trend to follow that trend. In this case, if price pulls back up into here, the first thing I'll be considering is, what am I waiting for to get a short on? So using moving averages can greatly improve your consistency in your trading. It's a way that we can combine price action and trend, but also to time. Whereabouts will this trend likely pivot and continue? Now, there's a lot more in this series as we'll continue to layer items on top of this. So please make sure you give me a follow, hit the subscribe button, turn on your notifications. If you have any questions, hit me in the comments, and don't forget to open your BloFin account on the link below. Have a great day. I'll speak to you in the next one.